There is a language spoken in the highest echelons of finance, a silent dialect of action and capital that separates the masters of the universe from the market's masses. It's not spoken in earnings calls, nor is it written in flashy press releases. It's a language of pure, unadulterated intent, and its most powerful word is an action so frequently misunderstood, so often misinterpreted, that for the 99% of investors, it remains background noise. But for the 1%, for the disciples of value, for Warren Buffett, this single action is a blaring signal, a flare shot up in the dead of night that screams three things: our management is confident, our business is cheap, and the shares you own are about to become profoundly more valuable. This action is the intelligent repurchase of a company's own stock, the corporate equivalent of taking a slice of the entire economic pie, setting it aside, and declaring to the remaining owners, "This is all yours now." And understanding the deep mechanics and philosophy behind this maneuver is not just another tool in your investment toolkit, it is the key to unlocking a different dimension of wealth creation, a dimension where you are not just a passenger in a company's journey, but a true partner whose ownership stake grows stronger, denser, and more valuable with each passing quarter. Let's begin by deconstructing the very foundation of this idea, the core philosophy of shrinking the pie to get a much, much bigger slice. This isn't merely a financial transaction, it's a strategic declaration of value. Imagine for a moment the chaos and uncertainty of the mid-1970s in the United States. The nation was reeling from the Watergate scandal, the resignation of a president, and an economy gripped by stagflation. The stock market was a brutal place, a landscape of fear and pessimism where value was discarded and panic was the currency of the day. In the center of this storm was the Washington Post Company, a legendary institution, but one whose stock was being treated like a pariah. The market, in its infinite short-term foolishness, valued the entire company at a mere $80 million. To put that in perspective, Warren Buffett, who had been quietly accumulating a stake and had taken a seat on the board, knew that the company's television stations alone were worth more than that, to say nothing of the newspaper itself, Newsweek magazine, and other assets. The entire enterprise was being sold for less than the sum of its most obvious parts. It was in this climate of extreme fear that a pivotal conversation took place, a moment that perfectly encapsulates the philosophy of the intelligent share buyback. The protagonist of this story is not Buffett himself, but the formidable Katharine K. Graham, the publisher of the Post and one of the most courageous chief executives of her generation. She had weathered the storm of publishing the Pentagon Papers, defied the White House during Watergate, and was now facing a financial storm that threatened to swamp her family's legacy. Most CEOs in her position would have done what was conventional. They would have tried to expand, to diversify by buying some unrelated business to signal growth. They would have hoarded cash out of fear, or perhaps paid a special dividend to appease nervous shareholders. Kay Graham, guided by the quiet counsel of her board member from Omaha, chose a different path, a path of profound confidence. She chose to use the company's own cash flow to begin aggressively buying back its own shares on the open market. Think about the sheer audacity of this move. At a time when everyone was selling, when Wall Street analysts were downgrading the stock, when the prevailing narrative was one of doom and gloom, the management of the Washington Post was executing the ultimate insider buy. They were taking shareholder money, the profits from the newspaper and television stations, and reinvesting it in the one business they knew better than anyone else in the world, themselves. And they were doing it at a ridiculously cheap price. Every share they repurchased for, say, $20 was a share they knew was intrinsically worth closer to $80 or $100. They weren't just spending money, they were executing a series of incredibly high-return investments, a corporate arbitrage of historic proportions. Buffett watched this unfold with delight. He understood the simple, brutal arithmetic of what was happening. When the program began, he was a significant shareholder, but his ownership percentage was fixed. As the Post continued to buy back its shares, the total number of shares outstanding began to shrink. The denominator in the ownership equation was getting smaller year after year. Let's say there were 10 million shares outstanding when they started. If they bought back 1 million shares, there were now only 9 million. The company's assets were still the same, the earning power of its television stations and newspaper was still intact, but the claim on those assets and earnings was now divided among fewer people. Buffett's slice of the pie was getting bigger, not because he was buying more stock, but because the company was buying out his fellow partners at a discount. By the early 1980s, this relentless campaign of intelligent capital allocation had dramatically reduced the share count. Buffett's ownership stake had ballooned, and as the market sentiment eventually turned, the stock price soared. That $80 million company became worth billions. The wealth creation was staggering, and it was achieved not through a flashy merger or a risky new venture, but through the simple, elegant act of a management team recognizing that the best investment on planet Earth was their own company, and then having the courage to act on that conviction. This story reveals the underlying psychological principle that makes the intelligent buyback so powerful and so frequently missed by the average investor. The principle is known as denominator blindness. Our brains are naturally wired to focus on numerators, the big headline numbers. We see a company's total profit, its total revenue, its total number of employees. We think bigger is always better. A company that earns $2 billion sounds twice as good as a company that earns $1 billion. But this is a cognitive trap. Value for a shareholder doesn't live in the numerator alone. It lives in the per-share reality. The true metric is earnings 10 per share, revenue 10 per shares, intrinsic value 10 per share, 10 per share. The denominator, the number of shares outstanding, is just as important, if not more so, than the numerator. Most investors suffer from denominator blindness. They simply don't pay attention to it. A CEO can announce that profits have grown by 10%, and the market cheers. But if, in that same year, the company issued 15% more shares to fund that growth, you, the individual shareholder, have actually gone backwards. Your claim on the company's earnings has been diluted. The intelligent share buyback is a direct assault on denominator blindness. It forces a focus on what truly matters, the concentration of value into fewer and fewer hands. It's a concept that also plays on another cognitive bias, the endowment effect. We place a higher value on things we own. As a buyback program progresses, your ownership stake increases from, say, 0.0001% of the company to 0.0012%. The pie itself hasn't necessarily grown, but your legal claim to it has. This subtle, almost invisible increase in ownership creates a stickiness and a sense of partnership that a simple dividend payment can never replicate. A dividend is a transaction. A buyback is a transformation of your relationship with the business itself. So how do we translate this powerful theory into a practical, applied mental model? Let's call it the shrinking pizzeria blueprint. It's a simple way to visualize and calculate the value of a share repurchase. Imagine you and 9 other people are equal partners in a single, successful pizzeria. There are 10 shares and you own 1. Your pizzeria is a great business. It generates $100,000 in profit every year after all expenses. As one of 10 owners, your share of that profit is $10,000. The business is so stable and profitable that you all agree it has a total intrinsic value of $1 million, making your one share worth $100,000. Now, one year, the pizzeria has an exceptionally good run. After distributing the usual profits, there's an extra $160,000 sitting in the business's bank account. What should the partners do with this cash? The typical, unfocused management team might suggest opening a second, riskier location, or maybe buying a fancy new oven that isn't really needed. They focus on growing the empire. But you, channeling your inner Buffett, suggest something different. You notice that 2 of your partners are nervous about the economy and want to cash out. They are willing to sell their shares, which you know are worth $100,000 each, for a discounted price of just $80,000 each. You propose that the pizzeria itself use its $160,000 in excess cash to buy their 2 shares and retire them. The 2 partners agree, happy to get the cash. Now what has happened? The pizzeria still exists. It still has its secret recipe, its loyal customers, and it still generates $100,000 a year in profit. But now there are only 8 shares in existence, not 10. You still own your 1 share, but your ownership of the pizzeria has magically increased from 1/10 or 10% to 1/8 or 12.5%. Your annual claim on the profits has jumped from $10,000 to $12,500, an instant 25% raise without you spending a single extra dime. Furthermore, the intrinsic value of your share is now higher. The $1 million pizzeria is now divided by 8, making each share worth $125,000. This is the magic of an accretive share buyback. It's not magic at all. It's just simple, beautiful math. The blueprint for applying this is straightforward. First, look at a company's financial statements and find the number of shares outstanding over the last 5 to 10 years. Is that number steadily decreasing? Second, look at the company's stock chart over that same period. Did the company accelerate its buybacks when the stock price was low and pull back when it was high? This tells you if management is opportunistic and value-oriented. Third, calculate the value created. If a company spent $1 billion to buy back shares when its market cap was $20 billion, it retired 5% of its shares. That means your ownership stake in the entire enterprise just grew by about 5%, a powerful and often tax-free return. Now we must explore the opposite path, the path of the 99%, the antithesis of this disciplined approach. The great enemy of the intelligent share buyback is the seductive allure of empire building. Most chief executives are not primarily rewarded for creating per-share value. They are rewarded for the size and scope of their domain. Their compensation, their prestige, their feature articles in business magazines are all tied to the sheer scale of the enterprise they command. They want to be in charge of a $100 billion company, not an $80 billion one, even if the smaller company is far more profitable and valuable on a per-share basis. This leads to a relentless, often value-destructive quest for growth at any cost. Instead of shrinking the pie to enrich the existing owners, they are obsessed with baking a bigger but ultimately less flavorful pie. This manifests as a desperate chase for mergers and acquisitions. They take the company's hard-earned cash, or worse, issue mountains of new shares to buy another company. The problem is that they almost always overpay. They get caught in bidding wars, they pay a massive "control premium," and they justify it with vague promises of synergies that rarely materialize. A classic example of this folly was the dot-com bubble. Companies with flimsy business models and no profits would issue stock like confetti to acquire other, equally flimsy companies. A company like America Online, at its peak, used its own hyperinflated stock as a currency to buy the venerable media giant Time Warner. The result was one of the most catastrophic destructions of shareholder value in corporate history. The focus was on getting bigger, on dominating headlines, on building an empire. The concept of per-share value was thrown out the window. The 99% of investors get swept up in this narrative. They cheer the big, bold acquisition. They love the story of growth and expansion. They fail to do the simple math of the shrinking pizzeria. They don't realize that the 10-slice pizza they owned is now a 20-slice pizza. And while the pizza is physically larger, their individual slice is now so thin, it's translucent. They have been diluted into oblivion. Their claim on the core business diminished in the name of a CEO's ego. The direct financial connection of this philosophy is stark and undeniable when you look at a company's core financial statements. It all comes down to that critical metric, earnings per share, or EPS. This is the lifeblood of stock valuation. EPS is calculated with a simple formula: net income divided by shares outstanding. Let's see how a buyback directly manipulates this for your benefit. Consider Company A and Company B. Both are in the same industry, and both earn a steady profit of $1 billion per year. Company A, run by an empire builder, has 1 billion shares outstanding. Its EPS is $1. Company B, run by a capital allocator in the mold of K. Graham, has been using its cash flow for years to buy back stock and now has only 500 million shares outstanding. Its EPS is $2. The market sees these two companies. Even though they generate the exact same amount of total profit, Company B will almost certainly trade at a much higher stock price. If the average price-to-earnings or PE ratio for their industry is 15, Company A's stock will trade around $15, while Company B's will trade around $30. The shareholder of Company B is twice as wealthy, not because their company made more money, but because management understood the power of the denominator. Now imagine you are an investor in Company A. A new, shareholder-friendly CEO takes over and initiates a buyback program. Over 5 years, they use profits to repurchase 200 million shares. The share count drops to 800 million. Assuming profits stay the same at $1 billion, the EPS now rises to $1.25, a 25% increase. The stock price, assuming the PE ratio holds, should also rise by 25%. This is wealth creation in its purest form. It appears directly on the income statement through a higher EPS, it influences the valuation on the stock market, and it increases your personal net worth, all while being remarkably tax efficient. Unlike a dividend, which is taxed the year you receive it, the gain in value from a buyback is deferred until you decide to sell your shares, allowing your enhanced stake to compound for years, even decades, untouched by the taxman. This is not just a theoretical advantage, it is a tangible, massive financial tailwind for any long-term investor. Moving beyond the core philosophy, we must examine the second pillar, the buyback, as a signal of supreme confidence. This is where finance intersects with human psychology. A share buyback is not just a mathematical event. It is the single loudest, most credible statement a management team can make. Words are cheap. A CEO can go on television and talk about a bright future. They can write a glowing annual letter. They can issue optimistic press releases. But when they take billions of dollars of the company's own cash, the lifeblood of the enterprise, and use it to purchase their own stock, they are backing up those words with the one thing that cannot be faked: cold, hard capital. It is the ultimate act of putting your money where your mouth is. There is no more powerful case study for this than the story of the American Express salad oil scandal in 1963. It was a crisis that threatened to bring one of America's most trusted financial institutions to its knees. A small division of American Express was in the business of field warehousing, essentially verifying and guaranteeing inventory for other companies. One of their clients, the Allied Crude Vegetable Oil Refining Corporation, run by a fraudster named Tino DeAngelis, claimed to have vast storage tanks full of valuable salad oil. American Express guaranteed this inventory, and banks issued massive loans against it. The problem was, the tanks were mostly full of seawater, with only a thin layer of oil floating on top. When the fraud was discovered, Allied went bankrupt, and the banks came to American Express demanding payment on their guarantees, to the tune of what would be over $1.5 billion in today's money. Wall Street panicked. The stock of American Express collapsed, falling nearly 50% in a matter of weeks. The narrative was that the company was insolvent, that the liabilities would wipe out its entire net worth. This was a classic Mr. Market moment, a time of extreme, irrational fear. A young Warren Buffett, running his small investment partnership in Omaha, was intrigued. He didn't just read the headlines, he did the work. He went to banks, to merchants, to restaurants. He would stand in line and observe customers. Were people still using American Express travelers' checks? Were merchants still accepting their credit cards? The answer was a resounding yes. He quickly realized that the scandal, while serious, was confined to a small, obscure division. The core businesses, the traveler's checks and the charge card, were immensely powerful brands that were completely unaffected. The fundamental earning power of the company was intact. He concluded that the stock was ridiculously cheap. He famously invested 40% of his partnership's entire capital into American Express stock, a bet the farm moment. But what gave him the ultimate conviction to make such a concentrated bet was a subtle signal he observed from the company itself. Amidst the panic and the chaos, the management of American Express, led by CEO Howard L. Clark, did something extraordinary. They calmly authorized the use of corporate funds to begin buying back their own shares. This was the signal. In the face of market hysteria, the people who knew the most about the company, the insiders, the executives who saw the daily flow of business, were not selling. They were not panicking. They were buyers. They knew, just as Buffett had concluded, that the scandal was a temporary problem that did not impair the long-term value of their incredible franchise. By buying back their own stock at those depressed prices, they were sending the most powerful message possible to the investment world. We are confident, we will survive, and we believe our stock is the best bargain in the market right now. For Buffett, this was the final piece of the puzzle. His own independent financial analysis was now confirmed by the actions of the insiders. It was a perfect alignment of interests. The stock subsequently recovered and soared, generating an immense profit for Buffett's partners and cementing the legend of his analytical prowess. But the deeper lesson is about the power of the signal. The buyback cut through all the noise, all the fear-mongering, and all the uncertainty. It was a beacon of rational confidence in a sea of emotional panic. The psychological principle at play here is the concept of asymmetric information. In any market, there is an information gap. The insiders, the CEO, the CFO, the board of directors, always know more about the company's prospects, challenges, and true value than any outside analyst or investor. This creates a fundamental problem of trust. How can we, as outsiders, believe what they say? The share buyback is a mechanism that bridges this information gap. Because it involves a substantial financial commitment, it is what academics call a costly signal. It's easy for a CEO to say the stock is cheap. It costs nothing. But it is very costly to spend $1 billion to back up that claim. This costliness is what gives the signal its credibility. The buyback also powerfully addresses what is known as the principal agent problem. In a large corporation, the shareholders, the principals, hire executives, the agents, to run the company on their behalf. But the agents' interests can diverge from the principals. The agent might want a bigger salary, a larger empire, or a more luxurious corporate jet, while the principal simply wants the highest possible return on their investment. An intelligent share buyback, executed when the stock is undervalued, is one of the purest moments of alignment between agents and principals. Management is using the principal's capital to take an action that directly and mathematically increases the principal's ownership and per-share value. It is a moment of perfect harmony, a stark contrast to the herd bias that gripped the market during the salad oil scandal, where thousands of investors sold their shares in a panic, transferring their wealth to the rational few, like Buffett and the company itself. This leads us to an applied mental model for evaluating this signal, the captain of the ship blueprint. When you are assessing a company's leadership, a crucial component of any long-term investment, you need to determine if you have a true captain at the helm. Imagine you are a passenger on a large ocean liner, and a violent storm hits. The ship is being tossed about, and rumors are flying among the passengers about the ship's integrity. What actions from the captain would give you the most confidence? Would you feel better if the captain was on the loudspeaker every hour, telling everyone to remain calm and that everything is fine? Or would you feel better if you looked out on the deck and saw the captain, using his own personal money, calmly buying up extra cargo space on the very ship everyone else fears is sinking? The action speaks louder than the words. The captain of the ship blueprint is a checklist to assess management quality based on their capital allocation actions. Item number 1 on that checklist. Does the company have a history of buying back its stock? And crucially, does it do so more aggressively when the stock price is depressed? This shows they are price-sensitive, and value-oriented. Item number 2. Do the executives, including the CEO, personally buy shares on the open market with their own after-tax money? This is an even more powerful signal of personal conviction. Item number 3. Read the first few pages of the company's annual report and the CEO's letter. Is the language focused on vague concepts like growth and synergies, or is it relentlessly focused on metrics like, quote, per share intrinsic value and return on invested capital? A true captain talks constantly about increasing the value of each individual share, not just the overall size of the ship. This blueprint moves your analysis away from just looking at spreadsheets and forces you to evaluate the quality and alignment of the management team, which is often the deciding factor in long-term portfolio growth. The antithesis to this path of confident, aligned leadership is the path of diversification. This term, coined by legendary investor Peter Lynch, describes the all-too-common tendency of companies to expand into areas they don't understand, often with disastrous results. A diversification-driven acquisition is the polar opposite of a confident share buyback. A buyback signals, our core business is so good and so cheap, it's the best investment we can make. An ill-advised acquisition signals, we are so uncertain about the future of our core business that we need to desperately buy some other, hopefully faster-growing business to distract shareholders. It is a profound signal of a lack of confidence. The AOL-Time Warner merger remains the poster child for this destructive behavior. AOL, the king of the dot-com bubble, was a company built on dial-up internet access, a technology that was already becoming obsolete. Instead of facing this reality and returning its mountain of cash to shareholders or investing in a new core technology, its management, driven by ego and a desire to remain relevant, used its hyperinflated stock to buy Time Warner, a solid but slow-growing old media company. The strategic logic was a flimsy fantasy about synergies that never materialized. The reality was a clash of cultures, a mountain of debt, and a catastrophic destruction of shareholder value that incinerated hundreds of billions of dollars. The management team wasn't acting as confident captains. They were acting as panicked sailors, lashing their ship to another, bigger ship in the middle of a hurricane, hoping it would somehow save them. The 99% of investors who cheered this deal were focused on the headline, the scale, the sheer audacity of it. They failed to see it for what it was, a desperate, value-destroying act, born of fear, not confidence. The direct financial connection here is found on the balance sheet and in the calculation of a company's return on equity, or ROE. When a company buys back its own stock, the transaction reduces the amount of cash on the asset side of the balance sheet, but it also reduces the amount of shareholders' equity on the liability and equity side. Because the number of shares has decreased, the book value per share can often increase. More importantly, it supercharges the ROE. Return on equity is calculated as net income divided by shareholders' equity. It measures how efficiently a company is using its equity base to generate profits. Let's say a company has a net income of $1 billion and shareholders' equity of $10 billion. Its ROE is 10%. Now, if that company uses $2 billion of its cash to buy back stock, its equity base shrinks to $8 billion. Assuming net income stays the same at $1 billion, its ROE instantly jumps to 12.5%. This is not an accounting trick. It's a real reflection of increased efficiency. The company is now generating the same profit on a much smaller capital base. High and rising ROE is a hallmark of a great business and a key indicator that sophisticated investors look for. A consistent history of intelligent stock buybacks is one of the most reliable ways for a company to improve this critical metric over time, signaling a high-quality business and management team, which in turn leads to superior portfolio growth and a greater chance of beating the market. This brings us to the third and perhaps most crucial pillar, the cold, hard mathematics of value accretion. While the philosophy is elegant and the signal is powerful, the entire strategy rests on an undeniable mathematical foundation. An intelligent share buyback does not just make you feel like a bigger owner, it mathematically guarantees you a larger claim on the company's future earnings. There is no better illustration of this principle in action than Warren Buffett's single greatest investment, Coca-Cola. In the late 1980s, Buffett, through Berkshire Hathaway, invested over $1 billion to acquire a substantial stake in the beverage giant. He was drawn to the company's incredible brand, its global distribution network, and its simple, profitable business model. But a key part of his investment thesis was his admiration for its then CEO, Roberto Goizueta. Goizueta was a master of capital allocation. He understood that Coca-Cola was a cash-generating machine. He also understood that after funding the company's ample growth opportunities, there was still a river of excess cash left over each year. Instead of squandering it on a foolish acquisition, Goizueta initiated one of the most aggressive and relentless share buyback programs in corporate history. Year after year, like clockwork, Coca-Cola used its profits to repurchase its own shares. Buffett documented this with glee in his annual letters to Berkshire shareholders. He explained the simple, powerful math. When Berkshire made its initial investment, it owned a certain number of shares, which amounted to roughly 7% of the company. Buffett then sat back and did nothing. He didn't buy a single additional share of Coke for over a decade. Yet every year his ownership of Coca-Cola grew. How? Because Goizueta was steadily buying out his other partners. The total number of Coca-Cola shares was shrinking. That 7% stake slowly and inexorably grew. It became 8%, then 9%, then 10%. By the mid-1990s, without investing another penny, Berkshire's ownership had climbed past 11%. Think about what this means. Berkshire's claim on the annual profits of Coca-Cola had increased by more than 50%. If Coke earned $10 billion, Berkshire's initial share was $700 million. A decade later, their share of that same $10 billion in earnings was over $1.1 billion. This increase was a direct result of the buyback program. It was a massive, tax-free return that was happening automatically, behind the scenes. Buffett called this, seeing his ownership in the business, grow at a good clip without our laying out a dime. It was the ultimate armchair investment, supercharged by an intelligent and shareholder-friendly management team. The psychological principle that prevents most investors from appreciating this mathematical magic is a combination of inattentional blindness and the framing effect. Inattentional blindness is our tendency to miss things that are in plain sight if we are not actively looking for them. A dividend is impossible to miss. It arrives as cash in your brokerage account or as a check in the mail. It feels real, tangible, you can see it, you can touch it. A share buyback, on the other hand, is invisible. There is no notification, no deposit, no physical evidence of the transaction. Your brokerage statement shows you own the same number of shares as before. The only thing that has changed is a number buried deep in the company's quarterly report: shares outstanding. Because it's invisible, most investors are blind to its effect. The framing effect compounds this problem. The dividend is framed as a return or income. It feels like a reward. A share buyback is often framed by the media as a company spending money or propping up its stock price. It sounds vaguely manipulative or wasteful. The reality is that an intelligent buyback is not an expense, it is an investment. The company is investing in its own shares, an asset it understands better than any other. When done at the right price, it is often the highest return, lowest risk investment available. By reframing the buyback from an expense to an investment, we can overcome this cognitive bias and see it for what it is: a powerful, tax-efficient, and mathematically certain method of increasing our per-share value. To harness this mathematical power, we can use an automatic reinvestment plan mental model. This is a blueprint for identifying companies that will automatically increase your ownership stake over time. Step 1. Identify a great business. This means a company with a durable competitive advantage, or what Buffett calls a moat. It should be a business that you can understand and that generates consistent and growing free cash flow. Step 2. Check the valuation. The magic of buybacks only works if the shares are repurchased at a reasonable price, preferably below their intrinsic value. A company buying back its stock at an all-time high is not creating value. It may be destroying it. You must have a conviction that the business is worth more than its current market price. Step 3. Analyze the company's capital allocation history. This is the critical step. Look back over the past decade. Does management have a clear, consistent policy of returning capital to shareholders? Do they favor buybacks over dividends? Most importantly, are they opportunistic, ramping up buybacks when the stock is weak? This demonstrates true alignment with long-term shareholders. Step 4. Calculate the shareholder yield. This is a powerful metric that gives you a more complete picture of the company's return policy. You calculate it by taking the company's dividend yield and adding the buyback yield, which is the total amount of money spent on buybacks in the past year, divided by the company's current market capitalization. A company with a 1% dividend yield and a 4% buyback yield has a total shareholder yield of 5%. This is the true rate at which the company is returning cash to its owners, and it is often a much better indicator of future returns than the dividend yield alone. The antithesis of this disciplined mathematical approach is what's known as the dividend trap. Many investors, especially those nearing or in retirement, become fixated on generating income from their portfolios. They exclusively hunt for stocks with high dividend yields. This is the path of the 99%, and it is fraught with peril. A high dividend yield is often a warning sign. It can mean that the company's stock price has fallen dramatically because its business is in trouble. The high yield is not a sign of strength but a harbinger of a potential dividend cut. More subtly, a company that pays out almost all of its earnings as dividends is a company that has signaled it has no profitable opportunities for reinvestment. It is a no-growth or slow-growth enterprise. The investor gets their immediate gratification, the small, taxable dividend check, but sacrifices the potential for long-term capital appreciation. They prefer the certainty of a bird in the hand, even if that bird is small and taxed, over the potential for 2 or 4 or 8 birds in the bush that can come from a compounding machine fueled by intelligent share buybacks. Let's compare two companies. Company A has a high dividend yield of 5%, but its earnings are stagnant and it has no buyback program. Company B pays no dividend, but uses all its free cash flow to buy back 6% of its shares each year when the stock is cheap. The income-focused investor will choose Company A every time. The value-focused investor, understanding the mathematics of accretion, knows that Company B is making them a 6% richer owner of a potentially growing enterprise. Every single year, all of it tax-deferred. Over a decade, the investor in Company B will likely have a far greater total return. The direct financial connection of this pillar is the undeniable, mechanical impact on earnings per share. Let us walk through a multi-year scenario to see the compounding power. Imagine a company, SteadyComp, that earns $1 billion in net income. It has 1 billion shares outstanding, so its EPS is $1. The stock trades at a P/E ratio of 20 for a stock price of $20. You buy 1,000 shares for $20,000. Now, SteadyComp's management decides to stop paying its small dividend and instead uses 10% of its net income, or $100 million, each year to buy back its own stock. In year 1, they buy back stock at $20 a share. $100 million buys 5 million shares. The share count drops to 995 million. Let's assume net income grows a modest 3% to $1.03 billion. The new EPS is now that $1.03 billion divided by 995 million, which equals roughly $1.03. Your EPS grew by 3.5%, even though the business only grew by 3%. Now let's compound this. Over 10 years, if the company continues this policy and the stock price appreciates moderately, the share count could easily decrease by 20% to 800 million shares. And if the business's net income has grown by, say, 40% over that decade to $1.4 billion, the EPS is now $1.75. The business's total profit grew by 40%, but the earnings per share, your claim on those profits, grew by a staggering 75%. If the P/E ratio remains at 20, the stock price would be $35, a 75% gain, plus you have avoided all taxes on this growth along the way. This is the engine of wealth creation. It is the subtle, powerful, and mathematically irrefutable advantage that intelligent share buybacks provide to the patient, long-term investor. Of course, this powerful tool can also be a weapon of mass destruction in the wrong hands. This leads us to our fourth pillar, the great differentiator, learning to separate intelligent capital allocation from destructive, ego-driven repurchases. Not all buybacks are created equal. In fact, a poorly executed buyback can be one of the fastest ways for a management team to incinerate shareholder capital. The key to unlocking the benefits we've discussed is learning how to spot the difference between a buyback that creates value and one that destroys it. The cautionary tale for this principle is the story of IBM in the 2010s. For nearly a decade, IBM was a darling of Wall Street for one reason: its relentless commitment to returning capital to shareholders. Under then CEO Jeannie Rometty, the company spent over $100 billion on stock buybacks and dividends. Year after year, the company's earnings per share would magically meet or beat Wall Street's expectations. The problem was, this was an illusion. It was financial engineering of the most cynical kind. During this period, IBM's actual business was in a state of terminal decline. Its legacy businesses were shrinking, and its attempts to pivot to new areas like cloud computing and artificial intelligence were largely failing. Revenue was stagnant or falling year after year. So how did they manufacture EPS growth? By buying back their own stock at a furious pace, often with borrowed money. They were shrinking the denominator to hide the fact that the numerator was decaying. This was value destruction on an epic scale. IBM was spending billions of dollars to repurchase its shares at very high valuations. The stock was not cheap by any objective measure. They were paying premium prices for a business that was in decline. It was the equivalent of our pizzeria owner buying out his partners for $150,000 a share when the business was only worth $100,000 a share and profits were falling. It was a transfer of wealth away from the remaining long-term shareholders. Why would management do this? The answer lies in the dark side of corporate governance. Executive compensation, particularly for the CEO, was heavily tied to hitting specific EPS targets. So management had a powerful incentive to hit that number by any means necessary. If they couldn't grow the business organically, they would simply buy back enough stock to shrink the share count and artificially inflate the EPS figure. This triggered massive bonuses for the executives. Even as the long-term health of the company withered, Warren Buffett himself fell for this. Berkshire Hathaway made a multi-billion-dollar investment in IBM, attracted by the seemingly cheap valuation and the massive capital return program. But he later admitted it was a mistake. He had misjudged the deterioration of IBM's competitive advantage and had been seduced by the financial engineering. He sold the entire stake at a loss, a rare and public admission of error that provides a powerful lesson for all investors. The what of a buyback is meaningless without the why, and most importantly, the at what price. The psychological biases that lead to these destructive buybacks are potent. The first is the agency problem we've discussed, where executives' incentives, short-term bonuses tied to EPS, diverge from shareholders' interests, long-term growth and intrinsic value. The second is a powerful overconfidence bias. A CEO who has seen their company's stock rise for years can begin to believe that it is a good buy at any price. They lose objectivity and fall in love with their own stock, ignoring clear signs of overvaluation. They confuse a great company with a great stock, but as we know, even the best company in the world can be a terrible investment if you overpay for it. Finally, there's confirmation bias. Once a company has embarked on a major buyback program, it's very difficult for management to stop. Every subsequent repurchase confirms their prior decision that the stock is a good buy, even if the facts on the ground have changed and the valuation has become stretched. They get trapped in a self-reinforcing loop of value-destroying behavior, and shareholders pay the price. To protect ourselves from this, we need a rigorous mental model, a buyback scorecard, to analyze any company's repurchase program. This is a simple checklist to perform your own financial analysis and separate the wheat from the chaff. Question 1 is the valuation check. Is the company buying back stock when it is objectively cheap? You can assess this by looking at its price-to-earnings ratio, its price-to-book value, or its price-to-sales ratio compared to its own historical averages and to its competitors. Is it trading below a conservative estimate of its intrinsic value based on a discounted cash flow analysis? Only a buyback executed at or below intrinsic value gets a point on the scorecard. Question 2 is the source of funds check. Where is the money coming from? Is the buyback being funded by the company's abundant, internally generated free cash flow? That's a sign of a healthy, cash-rich business. Or is the company taking on billions of dollars in debt to fund the buyback, like IBM did? This is a massive red flag, as it increases the financial risk of the entire enterprise. Healthy cash flow gets a point. Debt-fueled buybacks are a disqualifier. Question 3 is the motive check. What is the state of the underlying business? Is the company's revenue and net income growing, and the buyback is simply a way to enhance already strong performance? That's a good sign. Or are revenues and profits falling, and the buyback is being used as a smokescreen to mask poor operational results? A growing business gets a point. A shrinking one suggests financial engineering. Question 4 is the alternative use check. Is buying back stock truly the best use of this capital? Does the company have high-return internal projects it could be funding instead? Could it make a small, strategic acquisition at a reasonable price that would create more long-term value? A great management team will have considered all other options and concluded that their own stock is the most attractive investment. If that's the case, the buyback gets a point. A company that passes all 4 of these checks is likely engaging in intelligent, value-creating capital allocation. A company that fails one or more is a potential trap. The path of the 99%, the antithesis of this careful analysis, is to react to the headline. They see a news alert, Company X announces $10 billion share buyback program. They immediately interpret this as a universal buy signal. They don't ask about valuation, the source of funds, the motive, or the alternative uses of the capital. They hear buyback and they think good. This herd mentality is precisely what executives engaging in value-destructive buybacks are counting on. They know the headline will generate positive buzz and temporarily support the stock price, allowing them to distract from fundamental business problems. Investors who pile into a company like IBM in the 2010s, or a struggling retailer like Bed Bath & Beyond, which also spent billions on buybacks while its business collapsed, are falling for this trap. They are mistaking the action itself for a sign of value, without doing the critical work of assessing the context. They are the liquidity that allows the misaligned management teams to execute their destructive strategies. They are playing a different game, a game of headlines and sentiment, while the masters are playing a game of value and mathematics. The direct financial connection here is the concept of return on invested capital, or ROIC. This is arguably the most important metric for assessing the quality of a business and its management. ROIC measures how much profit a company generates for every dollar of capital invested in the business. A company with a high and sustainable ROIC is a wonderful business. A share buyback is, at its core, an investment decision. The company is investing its capital into its own equity. The return on that investment is the company's earnings yield, which is simply the inverse of the PE ratio. If a company's stock trades at a PE of 10, its earnings yield is 10%, $1 of earnings for every $10 of price. In this case, buying back stock is like making an investment with a guaranteed 10% pre-tax return. Now, a smart capital allocator will compare that 10% return to the potential ROIC of other opportunities. If they can invest that same capital into building a new factory that is expected to generate a 15% ROIC, they should build the factory. But if the best internal project only has a 6% ROIC, they should buy back the stock all day long. A company like IBM buying back stock when its PE ratio was 15 or higher, an earnings yield of less than 7%, all while its core business was crumbling, was making a demonstrably poor investment. They were choosing a low-return option that destroyed value for the long-term owner. Understanding this trade-off is the key to advanced corporate finance and the heart of excellent capital allocation. This brings us to our final and culminating pillar, the Berkshire Hathaway case study, a masterclass in how Warren Buffett himself weaponized buybacks for decades of compounding. This story is fascinating, not because of when Buffett bought back stock, but for the decades when he steadfastly refused to do so. From the 1980s all the way through the 2000s, as Berkshire Hathaway grew into a corporate behemoth, investors, analysts, and journalists constantly pleaded with him to initiate a share buyback program. The logic seemed obvious. The company generated enormous amounts of cash, and its stock was often seen as a good value. But for decades, Buffett's answer was a polite but firm no. His reasoning was the epitome of disciplined capital allocation. He explained in his annual letters that he would only consider buying back Berkshire stock if two very specific conditions were met. First, the stock had to be trading at a significant discount to his conservative estimate of its intrinsic value. And second, and this is the crucial part, he had to be convinced that buying back the stock was the most attractive use of capital available to him at that moment. For decades, that second condition was never met. Buffett was a master at finding incredible investment opportunities outside of his own company. He was a financial hunter, and the world was his jungle. He could use Berkshire's cash to buy entire businesses like See's Candies or the Nebraska Furniture Mart at bargain prices. He could take massive stakes in public companies like Coca-Cola or American Express when they were cheap. He bought a railroad, Burlington Northern Santa Fe, for a price that gave him a far better return than buying his own stock would have. His opportunity set was vast, and he rightly concluded that deploying capital into these external opportunities would create more long-term value per share for Berkshire owners than simply shrinking the share count. He was willing to endure criticism, to sit on mountains of cash, and to watch his own stock languish at times, all because he was playing the long game. He was focused on maximizing per-share intrinsic value over decades, not on propping up the stock price in any given quarter. Then, around 2011, something shifted. Berkshire had become so massive that the universe of potential needle-moving acquisitions had shrunk. It became harder and harder for Buffett and his partner Charlie Munger to find external investments that were both large enough to matter and cheap enough to meet their stringent return criteria. At the same time, Berkshire's own stock would occasionally dip to levels that Buffett considered a clear bargain. For the first time, the two conditions of his buyback rule were met simultaneously. The stock was cheap, and the alternative opportunities were less attractive. And so, with the same deliberate, rational calm he applies to all investment decisions, he began to buy back Berkshire Hathaway stock. The program was modest at first, but in recent years, as the company's cash pile has swelled to well over $100 billion and external opportunities have remained scarce, the buybacks have accelerated dramatically. In a single recent year, Berkshire spent over $25 billion repurchasing its own shares. It was a stunning demonstration of his principles in action. For 30 years, buybacks were the wrong move. Then, when the facts changed, he changed his mind and acted decisively. It was the ultimate case study in patient, rational, and shareholder-friendly capital allocation. The underlying psychology that allows Buffett to operate this way is a mastery of two powerful concepts: delayed gratification and opportunity cost. Most of the world is driven by an action bias, a deep-seated psychological need to do something. A CEO sitting on billions in cash feels immense pressure from the board and from Wall Street to spend it. Buffett is immune to this pressure. He is the master of delayed gratification, willing to sit patiently for years, like a crocodile waiting by the water's edge, for the perfect, high-probability opportunity to appear. He is perfectly comfortable doing nothing. This patience is rooted in his profound understanding of opportunity cost. He knows that every dollar spent on a buyback today is a dollar he cannot use to buy the next See's Candies or Coca-Cola tomorrow. Every decision is weighed against all other possible decisions. This relentless focus on opportunity cost is what separates the great capital allocators from the merely good ones. They don't just ask, is this a good investment? They ask, is this the absolute best investment we can possibly make with this dollar right now? This leads to a powerful mental model for our own investing, the Buffett two-prong test. Before you add more money to an existing position in your portfolio, which is your personal equivalent of a company buying back its stock, you must be able to answer two questions with a clear and definitive yes. Question 1. Is this stock currently trading for a price that I believe is significantly below its long-term intrinsic value? This forces a disciplined valuation check and prevents you from emotionally throwing good money after bad. Question 2. Is buying more of this stock the single best use of my capital right now compared to all other investment opportunities I see in the market? This forces you to think in terms of opportunity cost. Maybe you love the stock, but perhaps there's another, even better opportunity available. This simple but incredibly rigorous two-question filter is a powerful tool for wealth creation. It forces discipline, prevents emotional decision-making, and ensures that you are always allocating your precious capital to its highest and best use, building a portfolio with the highest possible probability of long-term success. The antithesis, the path of the 99%, is emotional and undisciplined. The average investor doesn't think in terms of opportunity cost. They fall in love with a stock and continue to buy it as it falls, a practice they call dollar cost averaging. But they do so without reevaluating the fundamental thesis. Is the stock getting cheaper for a good reason? Has the company's competitive advantage eroded? They don't ask these hard questions. They also feel a desperate need to be fully invested at all times, believing that holding cash is a waste. They don't appreciate that cash is not just a zero-return asset, it is an option on future opportunity. It is the ammunition you need to take advantage of the rare, fat-pitch opportunities the market will inevitably serve up. Buffett's patience with cash and his eventual, decisive use of it for buybacks is the polar opposite of the frantic, unfocused activity of the typical retail trader who is constantly churning their portfolio, driven by fear and greed rather than by a rational assessment of value and opportunity cost. The direct financial connection of this final pillar is visible right on Berkshire Hathaway's own financial statements. If you look at their annual report, you will find a line item, repurchases of capital stock, which details the billions spent. More importantly, you can track the number of Class A and Class B shares outstanding. You will see that number steadily ticking down in recent years. The math is astounding. Every share that Buffett repurchases for, say, $400,000 is a share that he believes is worth perhaps $500,000 or more. He is instantly creating $100,000 of value for every remaining shareholder with each transaction. As this process continues, the ownership stake of every Berkshire shareholder in its vast collection of wonderful businesses, Geico, BNSF, See's Candies, Dairy Queen, its massive stock portfolio, becomes more and more concentrated. Their claim on the future earnings of this unparalleled economic empire grows larger, quarter by quarter. It is the ultimate demonstration of how superior management quality, combined with a deep understanding of value and a patient, disciplined approach to capital allocation, leads to beating the market over the long run. It is the final, perfect synthesis of every principle we have discussed today. You have just invested your most valuable asset, your time, into acquiring a powerful new lens through which to view the world of finance and investing. You now possess a mental model that cuts through the noise of corporate press releases and the empty chatter of market commentators. You don't just see a, quote, buyback anymore. You see a signal of confidence. You see a mathematical equation for value accretion. You see a test of a management team's integrity and intelligence. This is a profound advantage, a tool that can help you identify a company that is actively working to make you richer, quietly and tax efficiently, day after day. But understanding this single powerful instrument of capital allocation is only one node in the complex, interconnected network of a truly superior investment mind. The principles that make an intelligent buyback work are deeply intertwined with other core concepts of value investing. How does this connect to the idea of a circle of competence? How does it interplay with the strategy of identifying businesses with durable competitive moats? The principle you've mastered today is powerful, but it's designed to lock into a larger, more comprehensive system for wealth creation. And the video that is now on your screen is designed to be the missing link. It holds the next piece of the map. The principle that connects this world of intelligent capital allocation to the very structure of the businesses that are capable of producing that capital in the first place. It is the bridge from understanding what management does with the money to understanding where that money comes from. Most people will stop here, satisfied with adding one tool to their collection. They will feel a flicker of insight and then move on. But you are not most people. The very fact that you have come this far proves that you are on a different path. The journey to true financial independence, to becoming a master of your own financial destiny, is a process of assembling a complete mental arsenal. It is about building a latticework of mental models in your mind so that you can see the world as it truly is. To continue that ascent, to add the next weapon to your collection, to forge the next link in the chain, click. Complete the connection.